and those boards, and it intrigued me enough to go do some research. Fast forward, I reached out to my chief architect from Marketo, sent him a rudimentary design and deck of what I was thinking about, and didn't hear back from him for about a month. And then he said, "Hey Nick, I've been looking at this for a month. No one's doing what you're talking about doing here. This is like a total game changer." And so we went off and said, "Okay, well, let's see if we can build the product." And so we went off and raised the pre-seed, and then from there we went on and built the company, raised the seed, a seed two, and then Series A is what we just closed in May.
Wow, congratulations.
Thank you.
What a journey. So your first time you ever raised, you went for a Series A off of a deck.
Yep.
Wow, that's crazy.
Learning number one, never do that.
So how much did you guys raise in that?
We raised about 7.5 in that, from slides at Trinsic. And, it seemed like a lot of money at the time, but as you guys know, as you're trying to scale, that doesn't go very far. Earning into your Series A valuations is tough to do at that point.
But at the end of the day, Gainsight, that's a big win to be able to have Gainsight come in. Nick is a great guy. I've met him a couple times.
Yeah.
Do you think that your Series A was helped with that acquisition or led to that? Or
I think it hurt us in many ways.
really?
And just got some bad advice, which is why I was keen to do this chat, because there's so much here that look, raising money and being a CEO, like I said earlier to you, Paul, is a lonely sport, and opinions in advice is like belly buttons, and when you're a CEO, there's a bunch of them that you get, and they're all different and shaped differently. So trying to get through those.
Some of them are full of lint.
Yeah. Some have lint in them. Some are Audis.
Some are Audis. Right.
But yeah, that's why I wanted to do this, because there's a lot of learnings I had over the last two businesses.
Wow, you have such a great background, and really appreciate you coming in to do some of the stuff. We've already got questions on the TFC pop-up channel. Fez is asking, did you find any partner to raise funds, or was there any strategic interest in funds?
Yeah. So I don't know. I've always gone the institutional route and priced rounds. So I just think that's, if you're going to build a long, durable company, you got to figure that out. And there's a lot of methodologies out there, but to me, it's about three things. It's TAM, team, and product. And if you've got a great team that is building a product that they're squarely able to build, and there's a TAM behind you, that to me is all you really need to go raise whatever you need to raise in this environment.
Amazing stuff. Good to talk to you again, Nick. I had the opportunity to chat with you a couple of weeks ago.
Hey, Bill.
One thing I don't think I ever had a chance to ask you is, what was the worst piece of investment advice that you ever received? Maybe not the deck raising for the Series A, but what did you have as something that you saw as like trusted advice getting into a round that probably shouldn't have happened?
Yeah, well, without mentioning any names, I was given advice from a prior board member of another company to do it that way, and from the venture side of the house, and that was probably incorrect advice to get. And you just went with it because you thought, oh, well, this person's been doing this for a long time, and it was my first time out the chute, and I would say, like I mentioned in the meeting, it's like, don't get caught up in. First of all, you have to tell a good story. You have to have the right deck,
Yep.
and you have to make that deck perfect. But just follow your own North Star. Figure out what that is for you, and because there's going to always be learnings that you're going to have on your own, and things you're going to glean from other people. But make it your own is the only thing I can tell you.
Got it. The authenticity is always going to bleed through.
Yeah, exactly. And I think I wrote in the channel here, Joel, that you have to practice your pitch, right, at the end of the day. And so putting together a list of suitors that you want to go after, putting them in tier 1, 2, and 3, and literally practicing that deck with the tier 3s listening to their objections, adjusting your deck, and then getting that deck fully tuned. That by the time you get to the stage twos, it's starting to roll off the tongue, and you're able to anticipate all the questions that are going to come up. And then so by the time you get to the tier ones that you probably really want to raise money from, it's just comes out naturally and has all the right slides in the right order with the right talk track and everything that goes with it. And that's kind of like the key learning there for me.
So practice, practice, practice.
Practice, and don't waste your good bullets up front, right? It's like, if you start going after like, oh, I want this, I want this VC, their tier one to be my first person I pitch to. Bad idea, in my opinion.
Got it.
We've got a question in here from Fez who's asking if you could share some of your negotiation experience.
Yeah, I mean, it's going to vary depending on where you are, Fez. It's like when you're early on trying to raise pre-seed, the things that they want are pretty rote. Most of these, if you're doing a priced round, they generally all want the round to be 20%. So whether that's one investor taking 20 or you one lead and one co-lead for 10% each, that's kind of rote. I mean, they have these floors that they want you to be at. Now, if you go above that, then I would say be careful and go find other suitors. But you should be prepared for every round from pre-seed to seed, my seed 2 and my series A to be somewhere between 18 to 20% dilution.
Nick, have you seen seeds changing dramatically in valuation? I remember a seed round at 10 to 50,000 is not even 5 years ago. I mean, but now you're seeing seeds that are in the high tens, millions. It's crazy.
Yeah. Yeah. Our pre-seed was 1.5, right? And then our seed was 3, and then I had a follow-on seed, which was another 3. So, we had raised 7.5 million before we even raised our series. So it's all about, getting the suitors that have conviction on your business. They're going to want to be part of it. And if you tell the right story and you have the right team, they're going to want to be part of your journey just as much as you want them to, invest in your business. They're going to want to be part of you.
For those that would have been traditionally going for like seed money and just above friends and family, do you have any advice with the changing environment?
No, I mean, look, I don't know if you need. I mean, look, if you have a business where you're struggling to get a pre-seed from an institutional, there might be something that you're not focusing on with your business to make it sound like it's healthier or bigger. My caution here is you get a lot of angels that want you to get a product and start showing revenue and all of this customers and stuff like that. And my advice is, if you're in a SaaS business and you start showing revenue, when you go raise another round, the conversation is going to quickly turn into your growth and CAC and all these crazy things that don't matter at that stage to begin with. But so kind of refrain from taking real revenue or saying, oh, we've got all this revenue and customers until you've raised your seed round, in my opinion, because, again, they're going to want to see growth rates at a certain rate and box, and just try and stay out of that box. Say, hey, look, we're trying to build the product. This round is about proving to ourselves that we can go build the product. This next round is about going to market. Now we're going to start our revenue path. This next round is about scale, and taking it in the right order is important.
Nick, I think that is such good advice, especially considering your background with Marketo, taking it from 3 to 300 million. Not everybody, not every tech founder, not every founder out there is going to be the founder that will take their company up to 100 million. So I think the way that you just outlined that with the different seed rounds and the different intent behind them is really important. Yeah. One of the things that I think is a common discussion is exactly what you just said, which is a lot of times you get the advice that you want to be able to show some revenue, and you're saying don't even, that opens up a Pandora's box that you don't want to do on pre-seed, right? Yep. So my question is, what about user research? I mean, how important is that to raising pre-seed or seed rounds where you, inside of your deck, you're not talking revenue, but you are talking about the user research that you've done? How valuable is that to raising successfully?
That's a great point. Very valuable in being able to say that I have 10 POC customers. We haven't started our revenue run, so we're not collecting revenue. We're trying to get the product stable to get product market fit and go to market fit after. But certainly in the first stage, you're focused on product market fit with POCs that are non-paying, in my opinion. All they want to see is that people are have the problem that you're describing. You have customers or prospects or POCs that are using the product, but you haven't started your revenue ramp yet. So that's very important in my mind. And from there, when you get the money, you can go there. Now, the thing that is important to show is pipeline. So, for example, with Synchrony, we generated, probably 1.5 million in pipeline before we even started raising the money based off of our outreaches and the things we were doing to sort of collect feedback on the business that we were trying to build. And so that's important to show. So you're showing like, hey, I've got 10 POCs that are using the product in production or whatever, in some state, even in their own testing. And I've got this pipeline of prospects that I can go after and start building my revenue. And that's, you still don't have go to market fit yet. You've got product market fit, you've got some demand generated, but then you have to go to the next step, which is like, okay, how do I get to go to market with my ICP and everything that I'm trying.
I think that's so smart. I mean, I can see if you're raising off of your pre-seed, if you open up that door for revenue, investors might invest because of the revenue, and then their expectation is growth.
That's right.
And exactly. So you're completely misaligned. And I've been part of startups where that has been the case. You don't even have product market fit yet, but growth is being demanded.
Yeah.
And at the end of the day, churn increases, and you have to move this massive ship to try to figure out product market fit. Another question related to that, when you're being this focused on each of the rounds that you're raising, do you tell those investors this is for product research, this is to get the MVP,
Absolutely.
and we're going to do another raise where it's for growth, and does that increase the likelihood that those investors you'll continue to raise from those groups?
They better. You should get commitment on pro rata on any rounds that you do. If you start having an investor that was in your seed that doesn't show up in your C2 or in your A, that sends signals to other firms. So definitely make sure that when you sign up with somebody that they're in it for the long haul with pro rata, that they're reserving more cash for your business than they initially invest into it, so that the reserves for your business is what you're interested in finding out about. And if they don't have reserves or they don't do anything like that, I'd say, keep looking, in my opinion, because it will send signals when you go raise your Series A, you're not part of it. Anyway, so that, that's kind of how I view that.
So it's really a matter of framing expectations, being able to stay in touch with them, keeping them where you're at with the building of the expectations versus, painting a picture that it's really rosy. This is more of a case of telling them how you're assembling both the team and the product.
Yeah. Sorry, Joel. It was Joel. Yes, exactly. You have a roadmap for your, like, hey, this round is for this round is for that, this round is for that, and make sure that you understand. Like, here's another common CEO new founder problem that happens because everybody says, oh, you don't want to be overly. The whole point is that you're going to get diluted. And so if you start focusing on dilution of these rounds, you're going to be optimizing for the wrong thing. So I would say if you have a durable business that's going to be long lasting and you don't really care too much about dilution, because at the upper rounds, C, D's, and E's, you're not diluting as much as you think anymore. And so you're sort of giving up some dilution early on to where you want to be. So don't get hyper focused on dilution early rounds. I mean, it's going to happen. There's not a whole lot you can do about that. And focus more on, like, how do I get so that the subsequent rounds are either going to give me the cash I want or the less dilution that I'm looking for in the upper round, if that makes sense. You guys still there?
Okay. Yep. Yeah, I was just putting in the chat that what you're telling us right now is money. This is such good advice. Oh, go ahead, Joel.
No, my apologies, Nick and Paul. I had to talk to my daughter real quick before she walked out of the house. You know, 10-degree issues. So Nick, I'm completely with Paul. There's so much intellect in these observations. I mean, who who were who were some of your mentors? I mean, with where you got here, how much of it did you figure out on your own? How much of it did you figure out with the advice of some advisors and mentors?
Well, when you make a mistake the first time, like it really makes you hardened to not make those same mistakes early on. Remember, I raised a Series A thinking like, oh shoot, I've got my Series, and that's what you were optimizing around, and you felt good about that. But at the end of the day, that was put the nail in the coffin for you, and so just do a lot of research. The first thing you need to understand is how does a VC's business work? How do they make money? What are they looking for? How does their carry work? Portfolio size increases, et cetera, and so forth. And so understanding the VC side of this is probably very critical for you to raise your own money. Because if you know what's important to them, you can adjust to their style of working or their goals, right? Because they have to be aligned. And so, yeah, no, it's a lot of reading, Joel. I have a lot of advisors that I surrounded myself with that are, top notch. I mean, you talk about Phil Fernandez and John Miller from Marketo, who are the founders of Marketo. Bill Portelli, who is just, he's like a CEO coach, but he was my boss for 7 years at CollabNet. So he and I have a close relationship, and he's raised, 6 or 7 rounds on his own as well at CollabNet. And just learning from them, but then doing the research to how's the market moved down from the time because you'll get advice from people that raised money in 2010 doesn't carry anymore. So be careful with that and do your own research on what's prevalent in today's fundraising climate versus what it was when they were doing. It's completely moved on. I mean, think of the valuation we're getting right now, 50, 70, 100x on revenue. That's the market we're in right now, where these folks in 2010, we're trying to raise 1 or 2 million at 10 to 12x or 15x at best. And so just be careful with the advice you get from people that did it 10 years ago or so.
Different climate.
Yep, absolutely. Nick, I want to dive quickly into just total addressable market and how you would recommend calculating that. Sometimes TAM is all over the map. What's some advice you could give our founders when they think about how to present that, where to put it, how to think about it, how to calculate it?
Two things there. One is, so I'll give you an example of how it was wrong. At Aptrinsic, I convinced myself that selling to SaaS businesses was a huge market. And guess what? When I was doing that research, there was 11,000 or 12,000 market. I thought, wow, that's came up with an ASP and sort of calculated my, market size from that. And the reality is that in that 12,000, 3,000 of them were really viable to afford an ASP of like 25 to 30K on an annual basis. And so then when you par down the TAM from that perspective, you start going like, oh shit, big enough? The most important thing that is picking a market that your initial entry into that TAM could be smaller. So for example, Syncari entered into a market where our ICP is revenue ops and we're selling the revenue ops. Now the product can other TAMs, right, and other ICPs. And so, but you have to win in one before you can go on to the next, right? And so when you're sizing your market, you size it, if you size the data market, it's, I don't know, some huge astronomical number that no one believes, or I don't believe it. But when you start doing like, who am I really going after and how many in the market and how many of those could I really penetrate, 20, 30% or something like that? Is that a big market? And then what are my TAM adjacencies that you have to identify? Because the one thing you're going to want to make sure investors understand is like, look, we're initially going after this. So the pie is this, we're going after this, and here's where we're going after next. And how we're going to continue to expand the business as we think about our TAM. So don't get too gyrated on showing the $2 billion TAM or whatever the heck people want to see these days, and sort of say like, hey, I'm entering this $2 billion market, but the initial part of this market is X, and this is what we're going to go after. And after we've conquered this, we're going to move on to Y and Z, and then show how your TAM expansion happens, as well as your customer expansion for each TAM, if that makes sense.
Yeah.
Totally, 100%.
I don't know if this is helpful to you guys or not.
Oh no, it just opens more question marks on my part. Fez, you feeling up to joining us? Why don't you join us up here on stage? I think that there could be some perspectives on what you're working on and building right now, and what Nick has done in the past. Just click the bottom left-hand button. Fez is working on a methodology for a safe note that I haven't seen quite the way it's being done with his company NeoITO. Who, just full disclosure, of course, I work with Fez. Meet Nick. Nick, meet Fez.
Hi, Fed.
No, I've been listening to Nick, so it's really interesting, and I think it's good to have now people who have experienced this and sharing their experience. So yeah, quite a learning experience. But I was thinking, Nick, on your sync carry, if I pronounce that right. So is this a problem that you found in your previous company that you're trying to solve, or is it something like an opportunity you thought, okay, let's jump in and
It's a great question. So at Marketo, we had a sync engine that connected Salesforce and Marketo together, and it was a full sync engine, and that was one of the basis for where the idea came from. It's like, why aren't iPads stateful synchronization across all these point-to-point connections that break your data all over the place? So that was observation number one that was a learning from Marketo. The second one is when we were at Marketo, we had something called batch campaigns that you can literally execute various random things like uppercase Mr. inside of the suffix field, or various change data value of a bunch of leads, and sort of running these batch campaigns that felt a lot like data management and data manipulation inside of the platform, going like, well, we never built it for that. We built it to send emails, trigger landing, all kinds of different things for that in market automation. And what I started realizing, like, well, there's a need here for people to want to solve the data problems inside of their organization that are, in my opinion, compounded by the fact that, this is probably going to be taboo to say, but we started building data warehouses and started stuffing data into those things, hoping that we're going to get where data was. But the reality is if people are really honest with themselves, that most data warehouse projects not only have not done well. And the reason is because when I move my data to, it may be centralized, but the reality is it's transformed from what's going on in my departmental or operational systems. And so what I discovered is like, well, listen, you really need that 360 customer view, but you need the insights to be distributed into the systems that are actually taking action on those insights for whether it's marketing or sales or support or et cetera. And so the idea for Synchrony came from learnings in both of these things, Viz.
Also, I'm pretty sure that what you do at Synchrony in terms of this data orchestration, you would have competitors in the same space. I always say there is a pie in the market, and it's up to the entrepreneur to take the slice of that pie. So did you start on this solving the problem knowing that there are already competitors, but you want to position differently, but with the intent that, okay, it's okay to have a small pie at the beginning?
Actually, I have a worse problem, Viz. There's no exactly. They use the same words, which is a problem. Like people say sync when they really mean dumb data copies between two systems. And so nobody's really done data unification across all these different connections. So there was a huge differentiation in what we're doing that is being, I'm going to say, clouded face from all the words that all the previous vendors have used to say those things. Like when people say the word sync and they really mean one-way copies of data between two systems, that's not sync, right? And so re-educating this market has been interesting to say the least.
So
Perfect.
lack of competitors is a big problem. It's,
Yeah, it's almost like, people say the same words, but they don't do this. Oh, I understand now. This is very different than what we're doing with, pick your iPass du jour or RPA du jour.
Very intriguing, actually. By the way, from a Synchrony standpoint. So Synchrony is a product company which is already in the market, or is it still in the development stage?
Oh, no, we've been in the market so 25 months ago. This was slides. We started selling about a year ago. We got to Series A viable revenue, and we just raised our Series A in May. And so now we're sort of in a growth phase right now to get go-to-market fit nailed down, if that makes sense.
well, that's awesome.
Yeah.
Well, Nick, this is we've got just 1 minute left, so if anyone has any questions, please pop those into the TFC pop-up questions. But you have brought so much clarity for me. I think you've brought so much clarity for our listeners as well in terms of how you can be more disciplined in how you raise. I think a lot of times we just want to get that, that pre-seed or that seed raise, and we're so focused on that we don't take the long-term view. And I think my biggest takeaway is you really, the more long-term view you can take, I think it gives your investors more confidence in you and your team. It shows that you're more disciplined, and it shows a lot more focus on what you're going to do with your money. That has been my biggest takeaway, which has been so valuable. So I appreciate you bringing that today.
Yeah, I appreciate you guys having me. It was fun.
Yeah, and
I try to. Yeah.
go ahead. I was speaking over you. My apologies.
Oh, no worries. I was just gonna say I try to respond to questions that are on your forums.
Yeah. A big takeaway from this that you framed differently for me, and you kind of touched on this, Paul, is you got to be thinking for the long game. You just can't be working from round to round and everything else. You've got to be able to, in essence, paint the picture from where the bar napkin is to the point that you're making constant accession and you have a realistic expectation that you're painting of what you're getting done on each round. That's language that you typically don't hear, and thank you.
Yeah, you're welcome. Thank you for having me.
Okay. Awesome.
Well, what's interesting too, Nick, is that after 25 months, you're in a Series A, so you've moved through the rounds pretty quickly.
I have. Yeah, we've done pretty well. Look, I told you the second part of this TAM product and team. Team is the most. I'd say 2/3 of that pie is having the right team. I mean, we've got my chief architect from Marketo, who is my CTO and co-founder, just a powerhouse engineering team that we've built. Aaron Landgraf, who heads up our marketing, head of PMM at MuleSoft. Ross Mason, who's a founder of MuleSoft, is on my board now and an investor. And, we've just got an amazing team. And I tell you, that makes a huge difference in your ability to execute, because as much as you think it's all on your shoulders, which it is as a CEO, you need the right talent around you. And we just literally hired the head of partners from Workato, and she's heading up our partner programs here. And so I'm just feeling really good about the talent that we've been able to recruit.
Awesome. Well, thanks again for joining us, Nick. Thank you to everyone who's up on the stage with us and for the questions. And we'll see you in the chat. Nick, thanks a lot.
Yes, sir. Thank you so much. Take care.
Awesome. Thank you.
Bye.
Bye.